Eric Mother, Mother.com, with the U.S. market analysis for the weekend of August 22nd, August 23rd, 2015. Let's take a look at how U.S. markets closed on Friday. Dow down about 3%, NASDAQ 3.5%, S&P 500 also down 3%. Gold, crude oil was down 2.3%, and we see that the VIX was up 47% for the day. Wow. For the week, S&P 500 was down 5.77%. For the week, the NASDAQ was down 6.78%, and for the week, the Dow was down 5.82%. Let's begin by taking a look at the NASDAQ weekly, where we can see that the trend line going back to 2012 on the weekly, that trend line has been broken, suggesting that the move off the lows of 2012, that velocity to the upside is now broken, suggesting that maybe at the very least sideways to down. So that trend line is probably something we need to remind ourselves that it was a nice run over the last 2-3 years, but market was honestly due for correction, and this is it right here. We also see that on the trend line on the weekly RSI, this line of support broke, and this week we are also moving below RSI 50. Once we broke below 50 on the weekly RSI some point during this week, the suggestion there was that we were going to be trending lower for the rest of the week. Yes, I did not know that it was going to be down 6%, but at least we were aware after the market moved below 50 that it was not a good week to try and play the long side. Let's take a look at the NASDAQ daily. And on the daily, all right, we see that it broke through the 200-day moving average, sliced through it pretty much, and also we see here that it broke through two lines we were watching for support on the daily RSI. So the line of support that has been support going back about 2-3 years has been broken. It also broke the RSI lows line. So once that break took place, that was just opening the floodgates, and that's exactly what we got. And so this down move here, to be very honest, is not a surprise. We take a look at the Dow weekly, pretty much same time analysis. On the weekly chart, we see that the Dow did already now confirm that it has the crossover between the 13-week moving average and the 34-week moving average, something it hasn't done over the last 2-3 years. So that's a bearish development, and we were suspecting that with that type of a market, that maybe generally speaking we roll over, and that's exactly what's taking place. So the Dow weekly with this 13-week undercutting the 34-week moving average, suggestion there is that week to week, month to month, this is not going to be a strong market as we go into the tail end of this year, probably into 2016 and beyond. On the RSI, again, two lines of support have failed. This line has been very instrumental in helping the market find recent lows, and let me show that to those who are new to this analysis. You can see the green line has been very good support, and we've used this green line for re-entry back into the market. As of right now, there's no bounce on that line. In fact, we broke through it, so that's a major change. Also, we see that the line connecting RSI lows broke right there. So those two lines broke. That's not good. Keep in mind that we could also see another push lower, because if the Dow moves below RSI level of 30.9, expect another big down week. So we also need to watch that level, because any movement below 30.90 on the weekly RSI suggests a big down week. If we take a look at the Dow daily, so quickly here, two lines of support failed. This line has been support, the green line, it failed, and also the line connecting recent RSI lows failed after multiple attempts to hold on the line. Finally, it fell, and today we are seeing a big drop in the market. Why? Because the daily is moving below the threshold of 30.90 right there. So that daily slash and trading below 30.90 is my technical reason why we are having a big down day in terms of the Dow. Take a look at the S&P 500 daily. and we see that the S&P 500 daily also on the weekly, this week we are cracking below 50, and as we move below 50 we expect a big down week. So once the market turned below 50 this week, we suspected this was not going to be a good week. Yes, personally was not expecting a 5% drop, but at least we were not playing the bounce in the market. Also, we were watching this level here, which was the previous recent weekly closing low for the S&P 500 at 2076. Once we broke through that, that's not good. We also see here that the 13-week moving average wants to do what the Dow has done, which is undercut the 34-week moving average. Generally speaking, that can also be looked upon as being a bear market signal. And just like the Dow, we can see here we failed to hold the 200-day moving average this week, which is not good, something it hasn't done in a while. Okay. Secondly, we broke the two lines that we've seen on the Dow and the NASDAQ. So we broke all support on the RSI, and Friday we see that S&P 500 dropped below 30.9, which is the technical reason why we are having this huge down day on Friday. Take a look at the S&P 500 hourly, and on the hourly, just a couple points here. You see that the hourly is trading below 30.90. So trading below 30.90 over the last couple of hours suggests that this is not the low. What's going to happen here is that the market is going to try and move higher at some point, but it is going to have to at least test that low, if not test it and move higher, or test it and fail. Because you can see even this period here below 30.90 was not the low, because the market came and tested it and eventually failed. Even this period here was not the low, which is here. The market had to come back and test it and break it before it moved slightly higher. So hope that makes sense. The fact that the RSI is trading at and below 30.90 here suggests that this is not a short-term low. Markets are going to try and rally. They'll come back and test that low. More than likely they'll break through it before we can even get any meaningful day-to-day rally. But eventually on this video I'm going to talk about the monthly charts and what they suggest, which is not a good picture for the remainder of the year and also going into 2016. We take a look at the 30-minute chart for the SPX, and we can see here again trading below 30.90 on the 30-minute time frame suggests that this is not the low. The low is going to come down the road after a brief rally, a retest. Whether it holds or not, we'll see, and then maybe from there we can build for multi-day, multi-week rally. For now, it don't look good. Previously, you can see that even the lows here was not the low. You had to test the lows and break them. This was not the low, which during this period you had to test the lows a couple of times, and as of right now those lows failed. So short term, I don't even see a reason for a meaningful, strong week-to-week rally. It looks very bearish in my opinion. We take a look at Apple. Take a look at a 4-year weekly chart, because I want to show you the line that we were looking for support on Apple's chart on the weekly seems to be failing, which is this line right there. The market has used this line once before for support, which is that period, and now we are breaking below that. That break does indicate to me that more than likely there's something that has changed in this market, which is a bearish tone. You also see here Apple showing crossover between the 34-week moving average and the 13-week moving average is bearish, generally suggesting that this market wants to go down. The last time we had a crossover which was bullish was here, which was middle of 2013, and from that point on you can see that Apple had a nice run here after that crossover between the 13-week moving average and the 34-week moving average, at least led to the market seeing a multi-year rally. Now we are looking at the exact opposite, which is the potential for this to be a strong reason for markets to be trending lower. So that's the risk here, is that over time we might be looking to record lower prices on pretty much all stocks that are tied to the general market. Now we take a look at the VIX right now trading at 27, and the VIX here you can see that this is almost a 110% gain for the week, just for the week. But I think the biggest takeaway here, in my opinion, is the VIX monthly chart. On the VIX monthly, a couple of things here. Number one, the monthly is moving to fresh 3-year highs. So that to me is a big deal. So I'll show you that fresh 3-year highs on the monthly RSI, and we see that at least one of the MACDs, if not both MACDs, are moving to fresh 3-year lows on the monthly RSI. Now also moving above 50 on the monthly RSI, as you can see here, moving above 50 or above 0, excuse me. So moving above 0 on the monthly RSI, monthly MACD. So the MACDs 3-year highs also moving above 0, both MACDs, and we see that the monthly RSI is moving to fresh 3-year highs. Okay, if that's the case, then this meets the minimum requirement for the ultimate Moore breakout, which is not a good sign. Why do I say that? Because if you go back, let's say about 12 years, and I'll show you that during the crash of 2008, in fact, let's go back a little bit further here. On a multi-year monthly chart, trying to say that. So multi-year monthly chart, long-term monthly view for the VIX. All right, what I want to get at here is, you see this big spike here in 2007 to 2009, that period there. Hope you can see that, this big spike. That spike took place. I'll show you that here in a second. Let me get my charts together. Okay, so that spike took place when the RSI jumped to 3-year highs sometime in 2007. All right, and also we see that it also jumped to 3-year highs on the MACDs and moved above 0 on the MACDs again in 2007. So here we see that the minimum requirements for the ultimate Moore breakout were met in 2007, and that to me is the reason why eventually this market had a major spike in 2008. And so if that's the case here, the risk in this current market is that we are looking at the same type analysis, which again is the fact that we are making a 3-year high on the monthly RSI, which is one of the requirements for a major breakout in any instrument. And also we are looking at the MACDs for the first time in many years, moving above 0, and also breaking out on both MACD timeframes to 3-year highs. Such is the case, the suggestion there is that we should not be too surprised if markets have a major drop, and more than likely that drop is going to take place very quickly. It's not going to be a slow drop. Markets don't just drop slowly. They tend to have major corrections over a short period of time. All right, if you take a look at the 4-year, let's take a look at a 4-year weekly chart for the NASDAQ. That's the Dow, but I want to begin with the NASDAQ because I want to show you there's a slight, and I say slight hope. Whoops. And I mean slight, because the problem now is that markets are making 3-year lows, and I'll show you that in a minute. But the problem here is there's a slight chance, very slight, that on the weekly charts, and this is 6 years worth of data, so just to be clear, this is 6 years worth of weekly data on the NASDAQ. So there's a slight chance that this line could hold on the weekly RSI. Slight chance. If it can hold on this line, maybe something like that, then we might get a chance to recover. But we have to see the support before we can start making those types of conclusions. So there's a slight risk here if you assume the market has to go straight down, that this holds. And this has been good at holding the market together over the last 2-3 years, and even here during these lows of last year. So if this green line holds, the market might have a chance of moving higher. Personally, right now I don't see it. I don't see that because the monthly charts are pretty ugly. Take a look at the S&P 500. Right there is where it needs to hold. Again, why? Because this green line on the weekly RSI has been holding the market during severe pullbacks. Even here in October, that held. So if this is to hold, support needs to come immediately. Otherwise, as we trade below the green line, the risk here is that it only gets worse. Let's take a look at the Dow. And the Dow here is showing signs of no support. You can see that it needed to hold this week, or at least in the current market, but it's not holding. So because the Dow is not holding right there, it's a break of that support line. That indicates a change in sentiment. This is where the Dow has been holding support over the last couple of years, but now we seem to be breaking that. You can see support held on the line during this pullback, support held on the line during this pullback, support held here during this pullback, but now we are breaking below that. And I think, to me, this is a subtle indication of a change in the market behavior and psychology. So that is the risk here, that the market could find support, but I don't see it, is my point. At any rate, let's take a look at, and while I was recording this, the market did go ahead and close. So the market is closed now, pretty much closing at the lows of the day. You know, and is it a surprise now? It actually makes a lot of sense. Why? Because if you take a look at the monthly charts, and we've been talking about the Dow monthly, giving us an indication of intention, potentially of going lower. You can see it broke to fresh 3-year lows, and that was a major violation. So once this broke to fresh 3-year lows, that was a major sign that the market was going to be in trouble. This month, the Dow is already cracking below 50, which is confirming a big down month, and we already see that that is making a lot of sense. On the monthly MACDs, the Dow is trading at fresh 3-year lows, and that's also not a good sign of where these markets want to go month to month. In fact, I encourage you to go to my YouTube channel and check out my playlist on the ultimate sell signal. Why? Because it's going to explain what's going on in the market. This series here explains the minimum requirements for a major sell signal in the market, and that's exactly what we are seeing in terms of the Dow. We take a look at the NASDAQ, and we can see that the NASDAQ has yet to break down like the Dow just did. So give me a second here, I'll show you the NASDAQ. On the monthly, the NASDAQ just now, or this month, is moving below 69.1. Keep in mind, it's been holding above 69.1 over the last couple of years during this bullish phase here. Market's been trading above 69.1 throughout the last couple of years. Since about February, March of 2013, market's been having this nice move, holding above 69.1. Now we are moving below 69.1 for the first time in many years. The indication there is that now we've changed momentum, and sentiment has also changed. S&P 500 as of right now is not also showing strength on the monthly. As you can see, we just slipped to fresh 3-year lows. As in terms of the S&P 500 monthly action, that's a major break in the trend line. That's a major sell signal. And also we take a look at the MACDs for the S&P 500. This is not good. The last time this happened was in 2007, late 2007, early 2008. We know what happened after that. And prior to that, the last time this type of thing happened was early 2000. And we know what happened after the 2000.com euphoria and what followed after the .com break. So I think ultimately what I'm trying to say here is, honestly, the monthly charts don't look great. What does that mean? It means you have to be very careful. You might want to wait. You might want to play cash. I mean, it depends on your strategy, but you have to be, generally speaking, very cautious, because the market could be up the next couple of weeks, but yet month to month it could be down. In other words, be careful. If this is truly a bear market of strength, it might take anywhere from 1 year to 3 years. Who knows? Maybe less, maybe more. It's all a guess, to be honest. We need to see the market showing us some type of technical indication of a change in momentum back to being on rally mode. For now, there is no such indication, in my opinion. Eric Mwathe@mwathe.com. Wish you all the best. Good luck, peace, and blessing. I am out. Yeah.